Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by my company, Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Well, we have another special show for you today. The show is called Commercial Real Estate Vectors for 2020. Please welcome my guest. It's Conway, and Casey is a senior economist for CCIM, and he's joining us here in Studio One. Casey, thanks for being with us again.
Thanks, Michael. Happy Thanksgiving to everybody.
Yes. And if you will, kind of start us off with the cycle. I mean, everybody's really concerned about the cycle being long in the tooth, and it seems like people are starting to get nervous. Should we be thinking about cycles that much?
No, I think it's well overplayed. I'm actually in the camp that no recession in 2020. I kind of look at 8 key metrics, a broad base of things from GDP and employment down to small business optimism and how commercial real estate is performing. I don't see any signs of pullback. The fundamentals are solid, lots of liquidity in the system. I just don't see it. I guess it's that thing that, whenever you get 124 months into a longest recovery, you start worrying about it's going to end. But we're performing really where we should have performed in the first third of this recovery, but didn't. And it shows what a little deregulation and a little fluid capital in the system will do for the economy.
So what are the indicators that are making some people a little more nervous? Is it GDP expectations moving forward?
Yeah, I think it's some of that. And I think it's, wow, we're not producing 200,000 jobs a month anymore, but when you're at 3.6% unemployment, you don't have that many to pull into the labor pool. I think you have to look at the numbers relative to where we are. And I think people aren't paying enough attention to corporate earnings. I spent a lot of time poring over the corporate earnings. And so if you take out what I call the self-inflicted 20, so the Boeings and the Under Armours, those companies that have done something internal to themselves to shoot themselves in the foot and pull it out, the third quarter, again, was very strong. So if you go back to 4 quarters ago, we implemented the tariffs. Oh my gosh, the sky is falling, the world's going to end. And each of the past 4 quarters, we've beat expectations. And we've done it again. And the forward guidance from companies are telling us, look, we're dealing with tariffs, we're redoing supply chain, we're finding efficiencies, the consumer's healthy and strong, small businesses happy. And so I really looked at those corporate earnings. They're telling us the next 6 months, and I don't see them telling us anything's wrong.
So the glass is half full then?
So I hate that analogy. It's almost as bad as the baseball, what inning we're in.
Yeah.
So I like, let's pay attention to the pitcher influence.
The pitcher.
So it's kind of like, when you're drinking margaritas or you're drinking beer, who cares whether your beer is half full or half empty? Where is the keg? Where is the rest of the pitcher? And the pitcher influences, the things that are really controlling corporate, the liquidity, the capital in the system, they're all telling us there's lots of margaritas up here to pour. We're no shortage.
What do you say to people that are concerned about trade wars and tariffs and the election of 2020?
Yeah, so I would say, I'm worried about one of those things, the elections. I really am. You look at what's happening in Washington, how we're tearing this country apart. So I tell people, don't worry about a recession next year. Worry about state secession after the election. So I really worry that this thing is just getting so polarized and we're ripping things apart. The politics is what's ripping our economy apart. Look at the time that we're wasting in Washington, D.C. right now, instead of focusing on things like getting USMCA passed for real tariff and trade issues. They're just not working on the fundamental things that we need to. But there's actually a term out there that's bantering around in terms of our own form of Brexit in 2021. It's called Flexit. It's where Florida and Texas say, hey, we vacuumed everything we need out of California and the Northeast, and we're leaving. So I tell them worry more about state secession and the politics than the fundamentals of the economy. The fundamentals of the economy are very good.
Yeah. What about banks? Are banks going to be doing as much commercial real estate lending in 2020 as they have? What do you see for the health of the banks?
Yes, that's a really good question. So, we'll do the on one hand, on the other hand. So on one hand, the FDIC just had their report come out on the health of our FDIC-insured banks. It's the best that they've been post the financial crisis. They're really solid in terms of earnings. They don't have big credit problems. So the health of the banks is really good right now. On the other hand, though, banks have enjoyed grazing on commercial real estate quite a bit. So we now are back to having the largest concentration of real estate lending in the banks than even before 2008 and 9. So we've got $4.3 trillion of total commercial real estate debt, and about 55% of that's in the banks. So are the regulators going to start to pull it back and put the reins on them, or are they going to let it go?
Mm-hmm. And if they do pull the reins back a little bit, the regulators do on the banks, is there plenty of other debt sources that should help us in 2020?
Absolutely, and that's why you look at all the different sources out there. I look at whether it's CMBS, they only do about $80 billion this year. We've got record low delinquency in CMBS, really good performance. If you look at the life companies, they're flush with cash. They're going to have lots of money to put to work in the early part of the year. So, they've been playing golf. They always play golf at the end of the year because they put all their money to work. So they get new money in the first part of the year. So for the first 6 months, they've got a lot. And foreign capital, we're probably going to set a record this year for foreign capital flows, both debt and equity. I was just up at the private equity international conferences, and they're all rich with cash. So there's no shortage of capital out there. And when you look at the rest of the world, you got 14 trillion of negative yielding bonds in the rest of the world. So when you go to Europe or Japan, they'll say, you got to pay us for us to take your money. That doesn't make very much sense. And you look over here, and we're still paying 150 to 200 basis points on our debt, 2-year and 10 years. We had a growing economy. We got appreciating commercial real estate. Where do you put your capital work? And that's what's really happening is we're seeing this flow of capital come in because we are growth, and we do pay a yield on our dividend. And I think that's really why the Fed is back to cutting interest rates. It's not so much that they're worried about full employment or price stability. They're worried about this quantitative easing nightmare in the rest of the world where it's attracting all that capital here, and maybe we've got to go to zero to neutralize it. So I don't think they're done.
So your expectations for interest rates are that they might cut some more?
I think the Fed's going to have to cut more next year. And it's not because of our economy. It's because of this imbalance in capital flow, because all this capital coming in from the rest of the world is creating these asset bubbles, the stock market at record levels, real estate going up in value. This is all that foreign capital flow in here, and I think they want to pinprick that asset appreciation.
Interesting. So let's talk about some of the property types out there moving forward, and if we will, let's start with housing. Because that's usually a big part of the economy. It seems like in past decades, everybody looked at housing. What do you expect moving forward there?
Yeah, so everybody's been trying to downplay housing and say it's in recession, and I've said for well over a year, home builders just aren't building unprofitable homes. It's hard to build under 300,000. So with the lower interest rates, it's helping that quite a bit. But I look at those that can't afford to buy a home have stayed or moved into the multifamily as they've gotten employed. So multifamily is very healthy. We're still in, depending on the market, 4 to 6% vacancy rate numbers. The rents are still going up. So I think there's a lot of opportunity there. We'll build what's profitable. And I think you look at the public builders again on their earnings reports, phenomenal numbers. They're known how to build it very profitably. So the big challenge we have in this country, particularly in the big markets, is where do we have affordable housing? And if you don't solve that problem, then I think you're going to retard your economic development. But and we're finding lots of solutions here in Atlanta. We're building new subdivisions where all the homes are for rent. We got mobile home communities popping up. In fact, the top performing commercial property type for the second year in a row is manufactured home communities. It's beating industrial by more than twofold.
Yeah, and what do you think is the main reason for that?
So I think it really is, again, the affordability is being pushed out. If we can't build a new inventory and you can't buy the new home, you really get pushed out. If the rents go up too much in the multifamily, you go down the next tier. Next tier opportunity is manufactured housing. And the other piece is kind of this not in my backyard. We're not willing to really experiment with things like tiny home subdivisions, manufactured housing. We've done it here in Atlanta, and they've done it in other parts of the country. I keep a running list each year of the things I thought I'd never hear, and one of them I recently did on talking about housing was I saw one called Tiny House in Dallas. Now that's an oxymoron. Tiny house in Dallas. That's like a small suburban. And even Dallas is starting to play with, these infill pieces. What do we do with them? They're left over. Maybe that's a way to get affordable. Washington, D.C. has experimented very successfully with these accessory dwellings where they go into high-end older neighborhoods and they buy up the garages in the alleys and they convert those to affordable housing. So I think we're at a point where we could see some pretty creative solutions.
Yeah, and I think home values have have done well for most people, right? And I think if your 401k has done well and your home value's done well, and maybe you do have consumer confidence, what do you expect moving forward for holiday sales related to consumer confidence and that impact on the economy and then on retail, moving forward into 2020?
Yeah, so you look at the retailers, look at Walmart, look at Target, look at all the retailers that are reporting. There's misses by the apparel folks. They're having a hard time because more of us are going online than going into the stores. But I think we're going to see another year of 3% plus over year growth in sales. If I look at the package companies like FedEx and UPS, they're telling us, man, we're geared up for another record year. And then you look at the growth in online retail. Look at the growth in online groceries. You look at cars and autos, and we're migrating everything to an online platform. And there's more efficiencies in that, and the consumer's adopting it. So, and I think we're seeing some creative things in retail. It's not death retail. It's kind of small is the new big. So retail's not building as big as stuff. The big is the warehouse, and the small is still the showroom. Even Amazon's opening stores. A lot of the retail is being adaptively repurposed. So, look at these Toys R Us or closed stores, and we have a great example here in Atlanta right now with near Emory University, one of our older malls, North Lake Mall. Sears is closed, and all the old department stores, and the university's moving in, and they're putting work in one of the department stores and expanding, and that's revitalizing a lot of the smaller and the services and restaurants and other type stuff around it. So I think it's, retail's evolving. We just wrote a paper on it, retail evolution. It's not apocalypse. Get rid of that term. Evolution.
Yeah. And there's some retailers that are kind of maybe surprisingly opening stores, but there's still some closures that you expect?
Yeah, so we're running this year, we'll end up closing probably close to 10,000 stores. It'll be a record. But the headlines never capture, we'll probably open over 4,000. And one of the really interesting ones, interesting you asked that question, is Levi's. So Levi Strauss, your jean company, they relied on a wholesale channel. They primarily distributed their jeans through department stores. With all the department stores closing, Levi said, why aren't our jeans selling? And it's not because they weren't a good product, it's just they didn't have an outlet. So Levi's is actually going to open over 100 stores this next year. Gap and Old Navy, so even Gap overall, its stock is down. The Old Navy piece is going quite well. Old Navy's announced they want to open over 800 stores over the next 2 years. So not all retail is dead. It's just how do they evolve with logistics and the e-commerce platform, and what we're buying and consuming is different.
And how about your daughter's favorite store?
So I had to break the news to my two millennial daughters that one of their favorite stores, Forever 21, is not looking so good. So I track what the debt levels are, because most of the retail closings and bankruptcies that we've had have been because of over leverage. So I encourage people to really look at the financial condition of those retailers and their debt levels. And Forever 21 is one of the highest levels. So I'm actually okay with it because while the clothes really look good, my daughters look good in Forever 21 clothing, when they come home from college and they do their laundry, well, the first thing is I don't get access to the washer and dryer until about midnight. And then when I do get access, the dryer is full. They forget to empty their dryer. They went to bed waiting for Dad to do it. And when I open it up and I get the clothes out, and then I go to open the dryer lint vent, make sure it's clear, and there's like 2 inches of lint in there. Most of the clothes from Forever 21 end up in the lint vent after about 3 washings. So I'm hopeful that maybe they'll get a better brand of clothing.
There you go. And then when you think about retail, like you said, there's some changes on some of the retail being used for industrial, right, for distribution, for education, and as you mentioned, for office. And then retail is sometimes going into some locations where we might not thought of retail before, right?
Yeah. You're exactly right. So that's why I say the evolution. So the biggest one I'm very bullish about that we talked about in this new retail evolution paper with CCIM Institute in the University of Alabama is it going into hotel. So hospitality, I think, is going to be the new retail showroom. So what hospitality gets out of it is they now have a retailer come in and they fixture the place, they run the operations of the retail, and they get a slice of the revenue. They might get 10 to 15% of it. What the retailer gets is much lower occupancy costs, and they get closer to that customer. So one good example is Restoration Hardware. Restoration Hardware is going into museums and hotels, and so you might be sitting in the lobby there, and the hotel didn't have to pay for that furniture and fixtures, but they're all Restoration Hardware stuff. So you say, wow, this is a comfortable chair. I wonder who made that. Well, there's a QSR code, and you can scan it and order it from Restoration Hardware. So I think we're going to find retail and hospitality in a big way, and that's going to help hotels and retailers. We're also seeing it go into medical, hospital campuses, medical campuses. You got grandma and grandpa, they've either got to take the grandkids for the day for outpatient and got to stay with them, or vice versa. And they want a McDonald's or a Disney store or something in there. So that's evolving. So lots of places where retail's going in that we didn't think about before. And the retailers are developing their loyalty programs for the first time. And they're doing what the airlines did decades ago. They're partnering up with the hotels. So who knows, your next stay on a business trip at a Marriott may get you some points at your kid's favorite store or my daughter's Forever 21 while they're still open.
There you go. And it's interesting to see how Sticks and Bricks retail is really powering their business with the online. You know, I was shopping for a car the other day, and go in there and I scan the QR code. All of a sudden, I've got every detail on this car and every detail I could want. So you can really just kind of walk around and point it. All right, I got the details. It's a lot better than a sales guy. It's a lot more powerful when you have more information to make a decision.
And you don't have to walk around some 20 acres of land to find the inventory and hope it's there. Kind of like finding that Levi's pair of jeans. You can find exactly what you want, and Carvana or TrueCar will have it at your door.
There you go.
Tomorrow morning.
There you go. Well, I'm going to ask you about the future of the industrial market and the office market and some of the other factors that could impact commercial real estate and our economy moving forward. But for right now, we're going to take a quick break. We'll be right back. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com.